Stopped lending, businesses couldn't get credit. Stock markets plummeted. The Dow Jones fell over 500 points in a single day. The day after Lehman fell, the insurance giant AIG was on the verge of collapse. AIG had sold insurance on trillions of dollars of risky assets. If it failed, the entire global financial system would go down with it. This time, the government acted. The Federal Reserve provided an $85 billion emergency loan to save AIG. The financial system was in full meltdown mode. The bailout and the aftermath, saving the system. September and October 2008 were the darkest days of the crisis. Credit markets froze, businesses couldn't get loans to make payroll. Unemployment surged and fear gripped the nation. President George W. Bush and Treasury Secretary Henry Paulson faced an impossible choice. Let the financial system collapse and risk another Great Depression, or use taxpayer money to bail out the very banks that had caused the crisis on October 3rd. 2008, Congress passed the Troubled Asset Relief Program, TARP, a $700 billion bailout for the banks. It was deeply unpopular. Americans were furious that Wall Street bankers who had destroyed the economy were being rescued, while ordinary people lost their jobs and homes. But without the bailout, economists warned, the entire economy would collapse, banks would fail, ATMs would stop working, and the modern economy would cease to function. The bailout worked barely. Major banks, including Bank of America, Citigroup, and Goldman Sachs, received billions in government funds. The Federal Reserve slashed interest rates to near zero and launched massive programs to inject liquidity into the financial system by early 2009. The panic had subsided, but the damage was done. The recession officially ended in June 2009. But the recovery was slow and painful. The human cost millions suffer. The 2008 financial crisis wasn't just about numbers on a screen. It destroyed lives. 8.7 million Americans lost their jobs. The unemployment rate soared from 5% in 2007 to 10% in October. 2009, millions more were underemployed, working part-time because they couldn't find full-time work. The housing market collapsed. Home prices fell by over 20%. Nationwide, millions of families lost their homes to foreclosure, people who had worked their entire lives to own a home. Watched as banks took them away, the psychological toll was devastating. Poverty rates jumped from 12.5% in 2007 to 15.1% in 2010. Families struggled to pay for food, health care, and basic necessities. The crisis didn't just affect the unemployed. Even those who kept their jobs saw their retirement savings evaporate as stock markets crashed. 401k accounts and pensions lost trillions of dollars in value. The crisis also had deadly consequences. Studies estimate that 5,000 additional suicides occurred in 2009 alone, due to economic hardship, stress, anxiety, and depression. Soared as people faced financial ruin. The social fabric frayed, trust in government and financial institutions hit historic lows. Anger and frustration boiled over. In 2011, the Occupy Wall Street movement emerged, protesting inequality and the power of big banks. The crisis left deep scars on an entire generation. A global catastrophe. The crisis spreads worldwide. The 2008 crisis didn't stay in America. It spread like a contagion across the globe. Banks in Europe had invested heavily in U.S. mortgage securities. When those collapsed, European banks faced massive losses. Iceland's entire banking system collapsed. The government had to be bailed out by the International Monetary Fund. Ireland, Spain, and Greece were hit particularly hard. Their housing bubbles burst, unemployment soared, and government debt skyrocketed. This led to the European debt crisis, which lasted for years. The global economy contracted sharply. International trade plummeted, unemployment rose worldwide. The International Labor Organization estimated that at least 20 million jobs were lost. Globally, emerging economies like China and Brazil were affected, though less severely. China's export-driven economy slowed as Western consumers stopped buying goods. Governments around the world responded with stimulus packages and bailouts. But the damage was done. The crisis fundamentally changed the global economy. Growth slowed, financial regulation increased, and trust in the system was shattered. The legacy, a world transformed. The 2008 financial crisis ended officially in 2009. But its effects lasted for over a decade. The recovery was the slowest since World War II. It took years for unemployment to return to pre-crisis levels. Wages stagnated. For many workers, governments passed sweeping financial reforms in the United States. Dodd-Frank Act imposed stricter regulations on banks. Basel. 3 international banking standards were adopted worldwide. The crisis also changed politics. Populism surged on both the left and right. Voters, angry at elites and the establishment, elected outsiders. Bernie Sanders, Donald Trump, and Brexit all can be traced in part to the anger and disillusionment caused by the crisis. The crisis gave birth to Bitcoin and cryptocurrency. Distrust in banks and governments led people to seek alternatives. Decentralized digital currencies promised a financial system without too big to fail banks. The world learned painful lessons about risk, greed, and the dangers of unchecked financial speculation. But the question remains, what if none of this had happened? What if the housing bubble had never burst? What if the banks hadn't collapsed? What if 2008 had been just another year? The collapse that shook the world. Imagine waking up one morning to find that your life savings have vanished. Your job is gone, your house is being taken away, and the entire global economy is collapsing around you. This wasn't a nightmare. It was reality for millions of people. In 2008, the 2008 financial crisis was the worst economic disaster since the Great Depression of the 1930s. It began in the United States, but spread like wildfire across the globe. Banks collapsed, stock markets crashed, and unemployment skyrocketed. Over 8 million Americans lost their jobs, millions lost their homes, and trillions of dollars in wealth simply evaporated. The crisis destroyed lives, shattered families, and changed the world forever. But what if it never happened? What if the housing bubble hadn't burst? What if the banks hadn't collapsed and the global economy had continued to grow? What would our world look like today? Without the scars of 2008, this is the story of the financial crisis that broke the world and the alternate reality where it never occurred. Let's explore what happened and what could have been the housing bubble. America's dream turns into a nightmare to understand the 2008 crisis. We must go back to the early 2000s, after the dot-com bubble burst in 2000 and the September 11th attacks. In 2001, the U.S. economy needed a boost. The Federal Reserve lowered interest rates, making borrowing cheap. This sparked a boom in the housing market. Everyone wanted to buy a home. Home prices soared year after year. People believed housing prices would rise forever. Banks encouraged this frenzy. They offered mortgages to anyone, even people with bad credit or no income. These were called subprime mortgages. Banks didn't care if borrowers could repay because they weren't keeping the loans. Instead, they bundled thousands of mortgages together into complex financial products called mortgage-backed securities and sold them to investors around the world. Wall Street loved these products. They seemed safe because they were backed by real estate and they paid high returns. Investment banks like Lehman Brothers, Bear Stearns, and Merrill Lynch bought billions of dollars worth of these securities. They borrowed massive amounts of money to buy even more, using leverage of 30 to 1 or higher. This meant for every dollar they owned, they borrowed 30. This was incredibly risky, but profits were enormous, and no one wanted to stop the party by 2006. The U.S. housing market had reached unsustainable levels between 2001 and 2007. Mortgage debt rose nearly as much as it had in the entire rest of American history. But bubbles always burst, and this one was about to explode. The crisis begins 2007. The cracks appear in early 2007. The first signs of trouble emerged. Subprime borrowers, people with risky loans, began defaulting. They couldn't make their mortgage payments. Home prices, which had been climbing for years, started to fall when prices fell. Homeowners who had borrowed against their home's value found themselves underwater, owing more than their homes were worth. Foreclosures began to rise as home prices dropped. The mortgage-backed securities that Wall Street had bought and sold lost value. Investors panicked. They didn't know which banks held toxic assets and which were safe. Trust evaporated in August. 2007, the credit market seized up. Banks stopped lending to each other, fearing their counterparties might collapse. The Federal Reserve tried to calm markets by cutting interest rates, but the damage was done in December. 2007, the United States officially entered a recession, but the worst was yet to come. 2008 would be the year the financial system came within hours of total collapse. The fall of giants, 2008. The system collapses in March. 2008, Bear Stearns, one of Wall Street's oldest investment banks, collapsed. It had invested heavily in subprime mortgages, and when the market turned, those investments became worthless. The Federal Reserve orchestrated a rescue. JP Morgan Chase bought Bear Stearns for just $2 per share. The government provided $30 billion in financing. It was a warning shot, but Wall Street didn't heed it throughout the summer of 2008. More financial institutions teetered on the brink. IndyMac Bank, a major mortgage lender, failed. In July, it was the largest bank failure in over 20 years. Then came September 2008, the month that changed everything. On September 7th, the government took over. Fannie Mae and Freddie Mac, two giant mortgage companies that owned or guaranteed half of America's mortgages. Their failure would have destroyed the housing market entirely. On September 15th, 2008, Lehman Brothers filed for bankruptcy. It was the largest bankruptcy in U.S. history. Lehman had assets of over $600 billion. But it was drowning in toxic mortgage securities. The U.S. government decided not to bail out Lehman, hoping to teach Wall Street a lesson about moral hazard. This decision was catastrophic. Lehman's collapse sent shockwaves through the global financial system. Panic erupted banks. But what if the warnings had been heeded? What if regulators had stopped the housing bubble before it burst? What if 2008 never became a crisis? Let's rewrite history. What if the 2008 financial crisis never happened? Imagine it's 2006. The U.S. housing market is booming, but this time regulators see the danger coming. The Federal Reserve raises interest rates. Earlier, mortgage standards are tightened. Banks reduce leverage and subprime lending is curtailed. The housing market cools. Gradually, prices stabilize. Lehman Brothers survives. There's no panic, no bailout, no recession. The global economy continues to grow, and the world in 2024 looks radically different. Millions of lives saved. The human benefit in this alternate timeline: 8.7 million Americans don't lose their jobs. Unemployment stays around 5%. Families continue working, earning, and living normal lives. Young people entering the workforce in 2008 don't face devastation. They find jobs, build careers, and start families. Millions of homes are not foreclosed. Families keep the houses. They work decades to buy neighborhoods, remain vibrant instead of filling with abandoned Properties. The psychological toll never happens. 5,000 people who died by suicide in 2009 due to economic hardship are still alive. Stress and depression don't spike, families stay together. The American dream remains intact. People trust institutions and plan confidently for the future. A thriving economy, wealth continues growing. Without the crisis, the global economy continues its upward trajectory. GDP doesn't contract by 4.3%. Instead, it expands steadily by 2024. The global economy is 10 to 15% larger than in our timeline, trillions of dollars in additional wealth. Stock markets climb without crashing, retirement accounts grow steadily. Millions retire comfortably instead of watching savings evaporate. International trade expands. Globalization accelerates. Emerging economies like China, India, and Brazil grow faster, lifting hundreds of millions from poverty. The $700 billion TARP bailout never happens. Taxpayers don't rescue Wall Street. This preserves trust in the system, but it also means harsh lessons are never learned. Risky Wall Street behavior continues unchecked. The European debt crisis never happens. Greece, Spain, and Ireland don't face disasters. The Eurozone remains stable. Political consequences, a different world. The crisis reshaped politics. Without it, populism doesn't surge. The Tea Party movement stays small. Occupy Wall Street never happens. The specific anger about bailouts and inequality doesn't exist. Bernie Sanders' 2016 campaign lacks the rage about Wall Street. His movement is weaker. Donald Trump's campaign relied on economic anxiety and anger at elites without the crisis. Trump might not win his message. The system is rigged. Doesn't resonate when the economy has grown steadily. Brexit was driven by economic insecurity. Without the crisis, the vote might fail. The UK remains in the EU. Political stability means effective governance without polarization. Governments focus on infrastructure and climate change instead of constant economic recovery battles. Bitcoin never happens. The crisis that birthed cryptocurrency Bitcoin was created in 2009 as a response to the financial crisis. Satoshi Nakamoto's white paper was published in October 2008 at the crisis peak. Bitcoin was designed as a decentralized currency that didn't rely on banks or governments that had just failed in this alternate timeline. Bitcoin might never be created without the crisis. The motivating force, distrust in traditional finance, doesn't exist. People didn't lose faith in banks, so there's no reason to adopt risky digital currency. Bitcoin remains an obscure cryptographer idea. The entire cryptocurrency industry worth trillions doesn't exist. Ethereum, NFTs, and DeFi never happen. No crypto scams, no massive energy consumption from mining, no ransomware, but also no blockchain innovation. Smart contracts and decentralized finance are delayed or never develop faster. Innovation, more resources for progress. Without a recession, more capital flows to innovation. Venture capital doesn't pull back. Startups find funding easily. Tech advances rapidly. The smartphone revolution accelerates. Social media grows faster. Uber and Airbnb don't struggle. They expand quickly. Research gets more funding. The AI boom starts earlier. Renewable energy benefits from sustained investment, solar and wind technology advance faster. SpaceX doesn't face near bankruptcy in 2008. Space exploration accelerates biotech and medicine advance. Pharmaceutical research gets more funding, leading to faster treatments overall. Continued growth creates a virtuous cycle. More profits mean more R&D, leading to breakthroughs. Growing inequality. The dark side without the crisis, inequality grows unchecked in our timeline. 2008 exposed Wall Street excess. It sparked conversations about fairness, occupies. We are the 99% entered the lexicon without the crisis. This conversation doesn't happen. The wealthy accumulate faster, stock markets boom, executives get massive pay. The middle class sees wages stagnate, unions decline. Automation replaces workers without crisis, level unemployment. There's no push for reform. Minimum wage doesn't increase wealth, concentrates at the top. By 2024, the richest 1% might control even more than in our timeline. This creates tension. People notice the gap, resentment builds, but without a crisis catalyst, it simmers. Society is prosperous, but increasingly divided. The next crisis, will it be worse? Here's the critical question. Does avoiding 2008 prevent disasters, or just delay a bigger one? The fundamental problems are never addressed. Risky lending continues. Banks stay highly leveraged. Financial products grow more complex. The housing bubble inflates further. Eventually, it becomes larger than in our timeline. Too big to fail worsens banks grow even larger. Their failure would cause greater damage when the inevitable correction comes. It might be catastrophic without 2008. As warning markets take greater risks. The next crisis, whether housing tech or derivatives, could be worse. The question is, does avoiding 2008 make the system resilient or fragile? Does it give breathing room for reforms? Or let dangerous practices fester until they explode? Would it be better or worse? The impossible answer on the surface: a world without 2008 seems better. Millions keep jobs and homes. Wealth isn't destroyed. Trauma never happens. Economic growth lifts people from poverty. But deeper the picture complicates. Without the crisis, risky practices continue. The next crisis might be worse. Inequality grows, unchecked. Political change lacks a catalyst. The lessons of 2008, regulation oversight, too big to fail, are never learned. This makes the system vulnerable. Moreover, innovations born from crisis don't exist. Cryptocurrency, blockchain, and reform movements are weaker. The conversation about economic justice never happens as urgently. The ultimate question is whether short-term pain leads to long-term gain. 2008 forced changes and reckoning. Avoiding that pain might mean avoiding necessary evolution, leaving society unprepared for the next shock conclusion. A world transformed. The 2008 crisis destroyed wealth, lives, and trust. But it reshaped the world in a timeline. Without it, millions are better off. They keep jobs, homes, and peace. The economy grows and the world is wealthier, but fundamental problems fester. The next crisis might be worse. Society lacks awareness and reforms. From experiencing 2008, we learned painful lessons about risk, greed, and global interconnectedness. We saw consequences of unchecked speculation. Those lessons shaped policy and a generation. Whether we're better or worse is impossible to say. But one thing is certain: the world without 2008 would be unrecognizable. Prosperous in some ways, vulnerable in others, forever lacking hard-won wisdom from surviving catastrophe. 2008 crisis happened. We can't change that. But understanding its impact helps us appreciate our world and the lessons we learned. Lessons we must remember to avoid repeating history's mistakes. Don't forget to like, comment, and subscribe for more alternate history. Exploring the moments that changed everything.